Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 15th of July. I'm Daniel Lam, your host for the podcast. After resting for 2.5 months, I participated in a chess tournament over the weekend. I was very emotional about it because I played very well, but lacked luck at the end. Talking about emotions, many investors would remember UK Chancellor Reeves' recent policy reversal in welfare. The 10-year gilt yield has been rising because of renewed fiscal concerns. Investors are cautious about the potential rise in government borrowing. Now, some market participants are drawing parallels to the sell-off in October 2024 post-Reeves' autumn budget announcement. But compared to that episode, the recent rise in yield has been tame. Politically driven market dislocation is usually short-lived, and we're anticipating near-term monetary policy to be on track despite the fiscal noise. The UK economy stays sluggish and inflation is slowing, paving the way for the Bank of England to be cutting rates. So we're expecting the gilt yields to be drifting lower with target range of 4.25 to 4.5% over the next 3 months. And a 10-year yield at 4.6% or above offers an attractive entry point. But it is true that, in general, global bond markets are becoming more sensitive to the lack of fiscal space across developed markets, with only Germany having material fiscal flexibility. Now, Germany is about to launch a major spending initiative after years of being very conservative fiscally. Germany's government expenditure is expected to rise more than 6% in 2025, including a significant increase in defense spending. But despite such divergent fiscal paths, the 10-year bond yields are rising in both Germany and in the UK. Markets are expecting an increase in spending and borrowing costs across most of developed markets. And while there may be interim efforts to keep deficit widening under control, as we are currently seeing in the UK, the broader trend is towards increased fiscal stimulus to be supporting growth. The trend higher for DM bond yields is not necessarily disruptive to global markets, but the nature of the yield increase will be critical. So, for example, yields are increasing steadily because of the rise in nominal GDP expectations and a reduction in rate cut forecast. Then global markets may view that this is a benign repricing of rates. But a surge in yields and rates volatility on fiscal deficit concerns is going to be much more disruptive. And this second scenario, alongside the uncertainties from tariffs, are the key sources of volatility in risky assets in the second half of this year. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.